Lords, ladies, and gentlemen, my name is Sean O'Malley, and I'm a Senior Vice President and the Chief of the Financial Intelligence and Investigations Unit at the Federal Reserve Bank of New York. Although I'm a senior official at the New York Fed, this video contains my personal comments, and they may not represent the official position of the Federal Reserve Bank of New York or the Federal Reserve System. I truly appreciate the invitation from Professor Barry Ryder to speak at Jesus College at this year's 38th Annual International Symposium on Economic Crime. Unfortunately, due to the COVID pandemic, I'm speaking from my home in New York instead of from Jesus College's beautiful campus. I've attended over 15 of the symposiums on economic crime, and it's always been a special event for me. The content is always interesting and stimulating. However, I've always found that the people I've met and the friendships I've developed are amongst the most important parts of the symposium. Where else could I have had the opportunity to discuss complexities of financial crime, yet still had the time to talk about personal stories with dignitaries, such as attorney generals from Fiji and Gibraltar? I believe that the interactions with such distinguished financial crime counterparts with varying backgrounds from around the globe could only happen in Cambridge. It's an amazing environment. And this is only because of the hard work of Barry, Saul, Angela, Chizu, May, and so many others. I believe that this event is the most important annual collaboration of scholars, regulators, industry practitioners, and law enforcement officials in the whole world, the entire world. In my earliest years coming to the symposium, I made many connections with these financial crime professionals. And in 2004, and then continuing into 2005, when I was seconded to the United Nations as a senior investigator on the Independent Inquiry Committee to investigate the Oil for Food program, where we were able to prove that Saddam Hussein laundered billions of dollars in corruption proceeds, I was able to utilize the Cambridge connections to help cut through the red tape in order to help the committee obtain financial records from secrecy havens. The personal connections made at the symposium run deep, and it helps facilitate the ability to cut through that red tape. And I know that my experience is not unique. The topic for this year's symposium is economic crime: who pays and who should pay. I was supposed to speak at one panel and then 2 workshops this year, so I'll try to capture my thoughts and put them into the time I have allotted. The cost of economic crime is staggering, and the impact to society can be devastating. Governments and international bodies such as OECD and FATF have been working together for decades to fight economic crime, such as fraud, corruption, kleptocracy, as well as drug and human trafficking. The cost of financial crimes has impacted citizens across the globe in a clear and distinct manner. One example would be the cost of insurance fraud. It's enormous, and the fraudulent claims put in by scammers result in higher insurance premiums that are paid by all policyholders. This is a clear way to determine the impact of crime in the insurance industry. In other industries, it may not be that clear to society about the impact. In the United States, much has changed since the attacks of 9/11 and the resulting passage of the USA Patriot Act. The law pushed much of the financial burden of monitoring, detecting, and reporting suspicious activity for financial transactions onto the financial sector. Banks long have had robust fraud monitoring systems for credit card activity because each dollar of fraud that could be prevented was an additional dollar of expense that was averted and increased the bottom line for these institutions. It made total sense to spend money on fraud detection if every dollar spent caused a huge multiple in profit. The industry, though, did not have the same financial incentives to deter money laundering. Although victims were often impacted from money laundering, the victims were rarely the banks. The cost to monitor and detectives report this money laundering activity did not cause a corresponding increase to any bank's net profit. In fact, it just did the opposite, right? It reduced the profit significantly. So a lot of banks had systems, but they were not necessarily robust. We know that better information about banks' customers will enhance relationships, and it might even lead to additional business activity, but the benefits are hard to quantify. So although a strong KYC might stop a fraudster from obtaining a loan from an institution that's going to be a failed loan, the loss was never really incurred So it's hard to quantify the potential losses that were averted, and therefore the net cost savings due to enhanced due diligence are fuzzy. It's not always crystal clear. Although the cost-benefit analysis is crystal clear to those in the C-suite related to fraud detection, those are clear, necessary expenses because it increases the profitability of these institutions. That's not the case for AML programs. The obligation to be a gatekeeper was hoisted upon the financial industry in the United States by lawmakers, initially with the Bank Secrecy Act, but much more so by the USA Patriot Act. Since the Patriot Act has a strong impact on U.S. dollar correspondent relationships, I would argue that this law ended up changing global AML obligations and expectations because so much of the financial activity revolves around dollar clearing as a reserve currency. I'm very aware that the industry's complained that they were being asked to do too much and that they should not be the policemen for financial transactions. But unfortunately, the banks are the ones who had the information that law enforcement needed. And after 9/11, the U.S. lawmakers were no longer worried about what the bank's lobbyists were going to complain about. They were just worried about keeping the country safe. So the banks were tasked with the responsibility to monitor the U.S. financial system, whether they liked it or not. In addition to the AML regulations, the need to adhere to U.S. sanction laws, also known as OFAC laws, became critical in the post-9/11 environment. And although OFAC obligations were always required, the scale and scope of the U.S. sanctions program has dramatically increased post-9/11. Unfortunately, in those days, many banks were ill-equipped to meet their new obligations, and the New York Fed ended up having to enter into many enforcement actions and consent orders in order to force the banks to meet their new AML obligations. This required the banks to spend huge sums of money on new monitoring systems, to pay significant wages to hire competent AML professionals who were in short supply, and increase the compliance staff headcount significantly. The New York Fed then, coupled with other regulators such as OFAC and with law enforcement officials from the Department of Justice and from the Manhattan District Attorney's Office, we found that many overseas affiliates of U.S. banks were taking steps to intentionally evade the OFAC laws. Sometimes the overseas banks were using the lack of transparency in certain SWIFT messages, the bank-to-bank payment messages, to process U.S. dollar payments without detection through the United States. And that through that lack of transparency, they were able to process transactions without generating alerts. In other instances, they stripped out the offending words that might have generated an alert in an OFAC filter. But in both instances were very problematic to the U.S. regulators. The tactics used to circumvent the U.S. OFAC regulations were found to be applied by many European banks, and the regulators and law enforcement in the U.S. used that information developed in the initial investigations to target additional banks. About a dozen banks were targeted. Settlements over the years resulting from the sanctioned investigations, which, by the way, are almost always coupled with AML monitoring deficiencies, started in the tens of millions of dollars in December 2005 in the first action that we had, and reached a peak of close to $9 billion for a French bank in the summer of 2014. The fines from those cases seem to be the catalyst for the financial institutions to finally beef up their AML systems and their sanctions programs. In addition, using that same cost-benefit analysis that we talked about for fraud detection, that was now being applied to AML and sanctions systems. The complex systems required to implement were cost a lot of money, but the cost of being caught and fined for bad activity was even worse, especially if the scandals would cost these CEOs their jobs. So don't misunderstand me. Things are not perfect with U.S. financial institutions. We still settled last year and first half of 2009, we settled two similar billion-dollar cases with institutions that had problems with their sanctions systems. Some institutions continue to have severely inadequate AML and OFAC programs, but they're largely in the minority. Most of the banks are doing quite well. The regulators and prosecutors still have ongoing investigations on certain financial institutions, and they may result in settlements in the coming years. And to be clear, these are not limited to sanctions-related investigations. Um, it's also worth noting that the regulators and lawmakers are keenly aware of the high cost of compliance and then the potential cost savings that the industry can utilize uh, and realize, with the use of artificial intelligence. U.S. regulators support the banks in the responsible, and that's a key word, responsible, use of technology to enhance the efficiency of their AML reporting systems. During the next 5 years, I believe that we're going to see many banks starting to effectively mine their transactional data in a much more efficient way than today's rule-based alert systems. And in the next 10 years, it probably will be very common for banks to merge enhanced KYC data, linking it with the transactional data to better spot unusual trends and outlier activity. When determined to be normal business trends, the system will be able to automatically create new parameters for each high-risk client, and that will clearly reduce the number of false alerts, and that'll be best for the banks, and it'll satisfy the regulators' expectations. Hopefully, these new systems will be able to effectively manage and decrease the number of false AML and OFAC alerts that the banks encounter on a daily basis. And it'll allow the banks to significantly reduce the headcount of analysts reviewing unproductive alerts related to normal business activity. So this will be a win-win, and it'll be the type of thing that the industry is looking for. I doubt that the financial institutions will ever be relieved of reviewing their clients' activities, at least in the near term. However, I do believe that they will be able to partner with technology firms in order to streamline their AML and sanctions detection systems in a manner which will ensure compliance with relevant regulations. And that will also provide comfort to their regulators that they're meeting their AML, BSA, Patriot Act, and of course their sanctions obligations. So we have limited time, so I'd just like to thank you for your time, and I hope to see you in person at Cambridge in Jesus College in September 2021. Thank you.